So the market has certainly been finding some sort of direction of late, and a lot of it has been led by the tech counters, particularly out in 2020. It seems that some of that surge isn't necessarily fading away, but it does seem that the oversold stocks in 2020 may make a comeback in 2021. If and only if, of course, economies begin to revive themselves and get up to levels that they last saw back in late 2019, perhaps even early 2020 at some stage too. So the surges in some of these stocks has been quite interesting. If you start things off out in Asia, though, with this market front, well, economic news there does point to a flat stance, particularly when one takes a look at China's producer price inflation as well as consumer price inflation, both headed in opposite directions, but only marginal gains on either one, or marginal movements on either one as well. So the market perhaps not taking in a little bit of that information, but certainly the tech question just around whether the United States will indeed enforce that ban on a few companies, including, of course, Tencent as well as Alibaba, with regards to restriction of trade in the United States. Will that come to the fore? Because if it does, then liquidity becomes a big issue for some of those companies. But nonetheless, let's take a look at how things fared out in Asia, particularly a more positive start across the board. The Hang Seng and the Nikkei going up there, just 0.1% gain though for the Hang Seng, with the Shanghai Composite out in China losing more than 1%, unfortunately. So not a good day out on that front. The US market had closed in positive territory and record territory, in fact, going into or closing out last week. Negativity though does seem to reign supreme today, with some nervousness back into the market picture out in Europe, particularly a big fall for the DAX out in Germany, nearly 0.2% weaker. In fact, that's 88 points that it's lost. It now sits below that 14,000 point mark. All of that has unfortunately not hit South Africa, though, 0.5% stronger off to start off this Monday trading. It seems that risk on may be a little bit of a factor in this case, although markets perhaps still measuring up what will happen out in the United States with regards to more stimulus, as we have a democratically held Congress as well out in that market, and of course presidency being Joe Biden, around 10 days until he is in power officially. 0.5% stronger then for the all share today in this lunchtime trading picture, 63,875 points. But despite the positivity there are some negatives. Financials have gone down 0.9%, and a lot of that coming from the banking counters, unfortunately, with the resource also going down, resource shares getting a hit 0.2%. A lot of that is led then as well by the gold mining companies, which aren't doing necessarily too well overall on this market front. Then industrials gaining nearly 2% today, so some positive movement over there, while the listed property segment in South Africa is 0.33% weaker, unfortunately. Naspers seems to be a good gainer today, 4.7% higher, and that comes as a big gain on that front. As I said, there are big question marks out in the United States as to whether Chinese corporations like Tencent, like Alibaba, will unfortunately be blocked on trading on Wall Street at any point in time. But it seems that it was far too battered. That's Tencent. So today it managed to go higher. And of course, Tencent is a stock that Naspers has quite a significant stake in. So if that one goes higher, Naspers generally follows. So 4.8% to the good. Prosus is of course a subsidiary of Naspers, and that is sort of following that market trend as well. So some positivity there. Negativity though out on this front, with Cartrack, of course, set to delist from the JSE as well very soon, and that's still playing into the market. So we keep on losing some there, more than 10% loss today. Big falls out on that front. On the currency, well, we're weaker, South Africa, 1.33% weaker, in fact, for the local currency, 15 Rand and 48 cents against the US dollar. A similar thing as well happening out with the combined currency of Europe. That's 18 Rand 83 for a euro there, while the British pound will set you back 20 Rand and 89 cents there. So some weakness as well for the Brent crude oil price, and this is a bit surprising, of course, then, considering that last week we had Saudi Arabia decide to cut the supply that it will set out for the rest of the world in February as well as in March. That meant that the price went higher. Today, a few more questions around demand being placed in the market, all because that demand question around coronavirus and whether the lockdowns in certain countries will mean that the demand comes down has then pushed the market a little bit, and so you're seeing the price just head a little bit lower to $55.19 a barrel. Platinum has also lost 1.7% today. It's at $1,046 a fine ounce. Gold is at $1,850 a fine ounce there. A big, nearly 13% fall in the Bitcoin price there. So still far too much volatility in that, although it does sit nearly $35,000 for one Bitcoin. All right, let's chat to Gary Boyson then from Rand Swiss as we unpack this market picture a little bit more. Gary, thank you so much for the time. Turbulent 2020. Nobody needs to really say that one out loud again. Expect much of the same in 2021?
Yeah, I think so. You know, the ticking over from 2020 to 2021 is really arbitrary. I mean, as humans, we look at it and say, oh, this is a time that we want to take stock and we want to look at it as a whole new year. But really, the fundamental drivers of the market are the same in the beginning of 2021, certainly as they were at the end of 2020. So, you know, certainly for the first half, I think we're still going to be struggling with the coronavirus, and we're going to be looking at you know, much harsher lockdowns in potentially locally, although there's, you know, I think it is commonly believed that we won't ever go back to the stringency of the lockdowns under level 5 that we did at the beginning of 2020. But, you know, we're seeing a flare up in virus cases in China as well. I think it's one of the reasons the market is off a little bit today, especially in China, and just concern. I mean, it's also, I think, bringing oil prices down a little bit. Just concern that if, you know, the world's second largest oil consumer, you know, has a proper flare up in terms of coronavirus cases, and we do see some sort of lockdown in China, we're going to see that ripple across the global economy. So I think the coronavirus is still with us. Lockdowns are still going to be very, very important. And I think the kind of rotation that we saw out of those work from home stocks, the Microsofts and those big tech players, is reversing to an extent as the market comes to grips with the fact that we might have a vaccine, but there's still a long way to go before we've conquered this virus.
Yeah, it seems, I mean, obviously issues with the vaccine is that it just needs to be done to a large scale for as many people as possible. And certainly the countries that have gone about it right now are certainly struggling. One wonders how we'll fare on the local front. And speaking of the local front, even our local indices, I mean, the likes of the property stocks absolutely hammered and battered last year as well locally. Is there any respite for all of those stocks that have been oversold this year, do you think? Or is that fully dependent on the recovery from the coronavirus?
I think the coronavirus is one aspect of what's driving, you know, financial market asset prices. The coronavirus can easily explain the economic data, but when you're trying to understand asset pricing, so when you're trying to understand what is going to happen with property prices, you've got to look at the stimulus packages that are coming in. You mentioned that I think it's by Thursday we're going to have a much better view of what the Democrats are going to do in terms of stimulus in the US. But the fact is that monetary policy in the US is probably going to remain accommodative for most of 2021 and all the way out into 2022. Lower interest rates, you know, are an unexpected boon for property companies. You know, if you look at it, the traditional relationship between listed properties and interest rates are, the lower the interest rates, the higher the prices of these assets. So obviously with the strict lockdowns and with so many businesses passing that burden on to their landlords, we've seen the property market stay fairly subdued. But if we do get back to a slightly more normal situation, yeah, I think you've got to be very selective in the stocks that you're buying. I think, you know, many office and commercial properties are going to be in a little bit of trouble. But if you look at a property company with good assets, and you know, and good vacancy rates, I think there could be an opportunity. I think there are some very attractive companies being, you know, tossing the baby out of the bathwater. I think there's some very nice opportunities in the property sector, but it's going to be longer term. We're going to have to see some sort of herd immunity or some sort of return to normal, and that, as we were talking about, it's reliant on the vaccine.
Yeah, I'm certainly very reliant by the seams of it out on that front. All right, let's talk about that oil price as well very quickly, if you don't mind. I mean, now back at around $55 a barrel there, it seems to be getting healthier and healthier. Is the short term perhaps looking towards 60? Because it just feels like the demand story, though, yes, it's faltered a little bit, you know, today, but following last week's announcement by Saudi Arabia, things have certainly progressed quite nicely for it.
So if you look at what's happened in 2021, we've had you know, a meeting of OPEC and OPEC Plus, and they've agreed to keep output unchanged. What happens with Russia is always a little bit you know, difficult to call, because Russia often proposes one thing and then just either pumps or cuts output. It's almost very random and usually in Russia's interests. But you know, Saudi Arabia, if you look at Saudi Arabia, one of the reasons the OPEC cartel works as well as it does is because Saudi Arabia can make these unilateral decisions to raise prices. So with them taking 1 million barrels per day out of the market, that has been very supportive of oil prices. Now, last week we got that at the same time as we had a drawdown in US oil inventories that was greater than expected. So essentially the US consuming far more oil than market participants were expecting. So on the supply side, we've got supply coming out of the market, and on the demand side, we've got people using a little bit more oil than expected. That helped to buoy the prices. Now, as I said, with the coronavirus cases lifting in China today, and I think concerns around what China's oil consumption is going to be over the next couple of months, that really is where the fears come from, and that's just helped to subdue any further gains in the oil price. But is $60 a barrel on Brent on the cards? I think absolutely. If you look at certainly what some of the oil majors are saying, so if you look at what the executive of, let's say, ExxonMobil is saying, there's a massive underspend in the oil market at the moment. There just isn't enough capex. They are not drilling enough wells at the moment to match the demand requirement. And in terms of listening to oil companies, and sure, they're talking their book, but for them it's a matter of if, not when, oil prices are going higher.
Yeah, matter of if. Unfortunately, not good news for our petrol price here locally, especially if the rand continues to weaken as it currently is doing as well. Gary, thank you so much. A happy new year to you. We'll continue to have our chats, of course, across the year. Thank you so much for the time. Gary Boyson there from Rand Swiss, joining us from the Johannesburg Stock Exchange.